Welcome to This Explainer. Today, we're cracking open the Small Business Tax Playbook. If you've ever felt like you literally need a translator just to understand IRS rules, or you're terrified you're losing your hard-earned cash to clunky tax strategies, well, you are absolutely in the right place.
Let's just start with a super crucial question that every single entrepreneur needs to ask themselves. Are you overpaying your taxes? Are you leaving money on the table just because all these rules feel way too overwhelming to decode? When you're running your own gig, every single dollar counts. And honestly, sometimes the biggest drain on your profits isn't your rent or your software subscriptions, it's just a really inefficient tax strategy. So let's dive into this and see how we can keep a lot more of that cash right in your pocket.
First up, choosing your business entity. The way you organize your business actually dictates the effective tax rate you pay on your profits. This is basically the foundation of your entire playbook. Look at this massive contrast here. If you're a really profitable sole proprietor, you're facing an individual tax rate that can climb all the way up to 37%. Ouch! Now you might see a C corporation's flat 21% rate and immediately think, no way, I should definitely switch to that. But hold on a second. C Corps are subject to double taxation. That means the corporation is taxed on its profits, and then you get taxed all over again when you take those profits out as dividends. Meanwhile, as a sole proprietor, you might actually qualify for a 20% qualified business income deduction just to soften that 37% blow. It's a huge strategic balancing act.
To put this into perspective, massive 96% of U.S. businesses operate as pass-through entities, mostly sole proprietorships. That means the business itself doesn't actually pay the tax. The whole tax burden just passes right through to the owner. And if you are in that 96%, all your business income and your deductions are going to flow directly into this specific document, the Schedule C form. Think of this form as your business's ultimate financial report card for the IRS.
All right, moving on to reporting your business income, and specifically the bartering trap.
So what actually counts as income anyway? Spoiler alert, it's not just the cash, checks, or Venmo payments you collect. Let's look at a totally relatable example. Imagine you're a house painter. You make a deal to paint a local attorney's office, and in exchange, they handle a legal matter for you completely free of charge. No cash actually changes hands. You're probably thinking, awesome, free legal help and zero taxable income, right?
Yeah, think again. The IRS actually views exchanging services as taxable income. You literally have to report the value of those legal services you received as business income. How on earth do you value that? Well, you can base it on the attorney's standard cash rates, or you two can just mutually agree on a reasonable value. Don't get me wrong, bartering is a brilliant business tool, but it is absolutely not a tax loophole.
Next up, let's talk about maximizing business deductions, specifically vehicles and safe harbors. Deductions are your fully legal way to shrink that taxable income. But let's be real, tracking vehicle expenses is a massive headache. Meet an interior designer who runs a home business and constantly uses her personal car to drive out to client meetings. She definitely wants her tax deduction, but how is she supposed to prove her business mileage to the IRS without meticulously logging every single trip, every single day, all year long? Who has time for that?
Well, here is a real game changer. The IRS allows this huge time saver called sampling. If she strictly records her mileage for just the first 3 months of the year, January, February, March, and establishes a consistent, say, 75% business use rate, boom, she doesn't have to log another trip for the rest of the year. Assuming her routine stays roughly the same, she can just safely extrapolate that 75% deduction for the entire 12 months. It is all about working smarter, not harder.
And when tax season finally rolls around, all that cleverly sampled mileage info goes right into Part 4 of your Schedule C form, right under information on your vehicle. Just have that 3-month documentation safely tucked away in your files, and you are golden.
Moving from cars to equipment, here is another massive pain point for small business owners: depreciation. Do you seriously have to capitalize and slowly write off every minor little thing you buy for your business over several years? Let's look at another super relatable scenario. Think about a small motel owner who decides to upgrade the guest amenities. They go out and buy 24 brand new clothing irons, one for every single room.
Now, the math here is a total lifesaver. The total purchase rings up to $672, but the individual cost of each iron is only $28. Because that per item cost is so low, the owner can use what's called the de minimis safe harbor rule. That's just a fancy way of saying they can immediately deduct the irons entirely in the current year, rather than slowly writing off $672 over 3 or 5 years. But to grab this instant tax savings safely, you can't just guess or assume. You actually need to maintain a physical count of the items
items. And crucially, you have to attach a specific election statement to your timely filed tax return. It's just one simple administrative step, but it gives you an immediate cash flow benefit.
Moving on to navigating special tax rules, the 5% incidental rule.
So many modern entrepreneurs mix different types of business under one roof now. Consider a dermatologist operating an LLC. They use the exact same staff and office space to provide their core medical services, but they also sell retail skincare products to their patients on the side. So are they technically running two completely separate businesses in the eyes of the IRS?
Well, let's look at the revenue split. If, say, 95% comes from medical services and just 5% from retail skincare, the IRS actually considers the retail side purely incidental. Because it stays at or below that magic 5% threshold, the IRS seamlessly bundles the whole operation into one single tax classification. You don't have to pull your hair out doing accounting for two separate business types.
We have covered a ton of ground today. Whether it's selecting the right entity to manage your tax bracket, properly valuing those bartered services, sampling your driving mileage to save time, or leveraging safe harbors for instant deductions, every single choice you make directly impacts your bottom line. So take a hard look at your own gig or small business and ask yourself, is your current tax structure secretly costing you money, or is it strategically engineered to legally save you every possible dollar? Knowledge really is your best asset here. Take these strategies, upgrade your playbook, and start taking control of your financial future. Thanks for hanging out.